Reports are hitting the market hard. Major banks are aggressively accumulating silver at $72 per ounce, a new all-time high that stunned traders worldwide. But the real panic signal? COMEX liquidation is underway, with short positions unwinding in volume and physical delivery demands surging to levels not seen in decades. Experts are calling this the early stage of a historic squeeze. The critical question dominating trading floors: is this the bank-driven panic that finally unleashes silver's full potential, or will it force a chaotic reckoning in the futures markets? The evidence is mounting rapidly. The implications are profound. Let's examine this development in detail. Because if banks are truly entering panic mode, the next moves could redefine silver's trajectory for years to come. What triggers banks to shift into aggressive buying at record highs? To fully understand this controversial development, we need to trace silver's intricate relationship with the financial system, a relationship that's always involved major institutions wielding significant influence behind the scenes. Silver has never been an ordinary commodity. Its exceptional electrical conductivity, reflectivity, and scarcity have made it indispensable for both monetary purposes and modern industrial applications. From ancient trade routes where silver coins facilitated commerce across empires to today's high-tech world, where it's critical for solar cells and AI data centers, silver has bridged the old and new economies. But in the modern financial era, banks and futures exchanges have played outsized roles in price discovery. The COMEX, the primary venue for silver futures trading, has long allowed vast paper positions that sometimes bear little relation to physical availability. This setup has kept silver volatile, yet often contained within ranges that suited large players. But the signals emerging in 2025? They're pointing to a potential breaking point in that control. A twist? Institutions that benefited from short positions for years are now reportedly covering or even accumulating. More on that soon. It's the development that's sparking liquidation talk and panic buying reports. History offers stark precedents for what happens when institutional positions collide with real-world forces. In the late 1970s, the world was gripped by economic turmoil. Inflation in the United States hit double digits. Oil prices skyrocketed after the OPEC embargo. Geopolitical tensions were elevated with the Cold War in full swing. Into this environment stepped Nelson Bunker Hunt and William Herbert Hunt, two Texas oil billionaires known as the Hunt brothers. They looked at silver and saw an asset that was severely undervalued relative to gold in the inflationary backdrop. They believed the world was heading for even greater monetary instability, so they started buying silver. At first, it was physical bars and coins. Then they dove into futures contracts on the COMEX exchange. Their accumulation was aggressive and relentless. Prices that had been lingering around $6 per ounce began to climb steadily. $10, $20, $30. By early 1980, silver had rocketed to over $50 per ounce. Short sellers, many of them large institutions, were caught in a vice. They had to buy back contracts to cover mounting losses, pushing prices even higher in a self-reinforcing loop. The squeeze was in full force. Markets panicked. But then came the system's response. Regulators and exchanges stepped in to protect the status quo. They dramatically raised margin requirements. The cash needed to hold positions. They limited how much any one entity could control. The Hunts couldn't meet the new demands for collateral. The market imploded on what became known as Silver Thursday, March 27, 1980. Prices plunged from around $50 to $10 in a matter of weeks. Billions of dollars evaporated. The Hunt brothers faced lawsuits, massive fines, and eventual bankruptcy. That episode revealed silver's capacity for legendary squeezes when accumulation meets leverage, but it also revealed a deeper truth. When the powers that be decide to protect the system, squeezes can be crushed quickly. Or can they? Because the lessons from that era are echoing today in ways that could surprise everyone. In more recent times, the hidden dynamic shifted to institutional players who wielded influence in subtler ways. In 2020, JPMorgan Chase, one of the largest banks in the world and a dominant force in precious metals trading, agreed to pay a record $920 million fine to U.S. authorities. The charge? Manipulating markets, including silver, through deceptive practices like spoofing, placing thousands of fake orders to mislead other traders and move prices in their favor. For years, major banks held enormous short positions in silver futures. Some argued it was legitimate hedging for client business. Others claimed it artificially suppressed prices below what the true supply and demand fundamentals would dictate. The gold to silver ratio, the number of silver ounces needed to buy 1 ounce of gold, stayed stubbornly high, often above 80 or 90 to 1, far from historical averages of 15 to 1 in ancient times or 40 to 1 in more modern monetary systems. This kept silver in the shadows, undervalued and overlooked by many investors. But here's the tease that's making waves now. What if those massive short positions are being covered rapidly? What if banks are now on the buying side in volume? Hold on. This institutional shift is the catalyst behind reports of panic accumulation and COMEX stress, and it's the piece that could drive the next explosive phase. How did we arrive at this point of reported bank panic buying and COMEX liquidation signals? The origins trace all the way back to 2020, when global disruptions exposed silver's vulnerabilities in a way that set the stage for everything we're seeing now. The health crisis hit mining operations hard. Peru, the world's second largest silver producer, saw mines shut down for months. Mexico, another heavyweight, faced similar halts. Bolivia and Chile, key players, all suffered. Global silver supply dropped 10 to 15% almost overnight. Recycling rates fell as industrial activity paused. At the exact same time, governments around the world launched the largest coordinated spending on green and digital technology in history. The European Union with its Green Deal, committing hundreds of billions to renewables. The United States with the Inflation Reduction Act, pouring trillions into electrification and infrastructure. China vowing carbon neutrality by 2060 and becoming the undisputed leader in solar panel and EV production. Trillions in total spending. And every dollar of it required more silver than anyone had planned for. But the scale of this demand wave? It was a tsunami that built slowly at first, hiding its power until it was too late to stop. Solar energy was the first major catalyst in this buildup. In 2020, the solar industry consumed about 100 million ounces of silver for conductive paste and photovoltaic cells. By 2022, that number had jumped to 150 million. 2024, over 200 million ounces. Why this rapid escalation? China became the solar superpower, installing more capacity in 1 year than the entire world had installed in the previous decade. Every photovoltaic panel requires silver paste to efficiently conduct electricity. And here's a detail that surprises most people. As panels become more advanced for higher efficiency, producing more power per square meter, they often require more silver per unit, not less. Thrifting efforts, using thinner lines or alternative materials, help at the margins, but the sheer volume of new installations overwhelms those savings. Global solar capacity is doubling every few years, and silver demand follows right along. Can you see the hidden explosion starting to build? Electric vehicles piled on as the second force, amplifying the demand in ways that were initially underestimated. A traditional internal combustion car might use 10 to 15 grams of silver in electrical components. An electric vehicle, 25 to 50 grams, sometimes more in high-end models with advanced electronics. Global EV sales exploded from roughly 2 million units in 2020 to over 14 million in 2024. Governments set aggressive mandates. Europe planning to ban new combustion engine sales by 2035. The United States offering massive tax credits. China dominating production with companies like BYD outselling Tesla in some quarters. Silver flowed into high-voltage batteries, power electronics, wiring harnesses, and sensors. This wasn't a temporary spike. It was the beginning of a multi-decade shift in transportation. Silver vanished into products that won't return as scrap for years. Then came the wild card that accelerated everything: artificial intelligence. Data centers, the massive facilities that power cloud computing, machine learning, and AI models, require the highest possible electrical efficiency to handle enormous power loads without overheating. Silver is the superior conductor, outperforming copper in high-performance applications. One large hyperscale data center can consume thousands of ounces of silver in wiring and connections. Hundreds of these facilities are under construction right now by Microsoft, Google, Amazon Web Services, Meta, and others. The AI boom is still in its early stages. Power consumption for AI training and inference is projected to double or triple in the coming years. And that directly translates to silver demand that has no viable substitute at scale. Do you feel the urgency building yet? Because these forces weren't isolated. They converged to create relentless structural deficits that show no signs of easing. Demand consistently outpaced supply. The Silver Institute reported a 142 million ounce shortfall in 2023, usage exceeding mine production and recycling by that amount. Forecasts for 2024 showed similar or larger gaps. And for 2025, analysts project deficits in the range of 95 to 149 million ounces, even after years of warnings. Where does fresh silver come from? That's the critical constraint. About 80% of silver is produced as a byproduct of mining copper, lead, zinc, and gold. You can't just ramp up silver production independently. It depends on the economics of those primary metals. And those projects face their own challenges: environmental regulations, permitting delays, capital costs. New mines take 10 to 15 years from discovery to production. Primary silver mines, those focused mainly on silver, are increasingly rare. Recycling has stepped up, surpassing 200 million ounces annually for the first time. But it only covers a portion of total demand. The rest has to come from above-ground stocks, inventories built over decades in vaults, exchanges, and private holdings. And those stocks have been draining for 5 consecutive years. The cumulative drawdown is approaching 820 million ounces. That's nearly a full year of global mine production vanished into industrial products that won't return as scrap for decades, if ever. Prices responded gradually at first, from $23 per ounce in January 2024 to $32 by December. The market shrugged. Investors focused on gold. The gold to silver ratio remained high. But 2025 was the turning point. The rise kicked off strong. $40 broken in March, powered by China's massive solar exports and new United States EV incentives kicking in. $50 by summer. The artificial intelligence hype cycle added rocket fuel as data center construction announcements came almost weekly. $60 in November. Physical tightness became impossible to ignore as inventories hit critical levels. But what pushed it over the edge? The breaking point in late November and early December. Prices that had been grinding higher in the mid-50s suddenly turned vertical, from there to over $72 in weeks. On December 17th, silver closed above $66 for the first time in history. By December 25th, $72. The trigger was clear, physical scarcity reaching critical mass. London Bullion Market Association vaults reported inventories at multi-decade lows. Eligible silver, metal in forms that can meet delivery, became scarce. Lease rates, the cost to borrow physical silver for short periods, hit levels not seen since the Hunt brothers era. Traders with large short positions faced massive margin calls as losses mounted. They had to buy back contracts at any price. Each repurchase pushed values higher, triggering more calls in a classic feedback loop. Exchange-traded funds holding physical silver saw record inflows as new money chased the move. Retail stackers, everyday investors buying coins and bars, rushed in, further tightening available supply. And reports emerged of major banks accumulating aggressively, flipping from legacy short positions to net long. The fallout was immediate and far-reaching. Short sellers, including hedge funds and some legacy bank positions, incurred losses running into billions. Reports of forced liquidations surfaced. Industries that rely on steady silver supplies felt the shock. Solar panel manufacturers saw input costs rise 20 to 30% in months, squeezing margins even as orders boomed. Electric vehicle producers scrambled to lock in supplies at premium prices, with some passing costs to consumers through higher vehicle prices. Efforts to thrift silver, use less per unit, accelerated, but newer high-efficiency technologies often countered that by requiring more silver paste to achieve performance gains. Physical market chaos ensued. Premiums, the extra cost above spot price for bars and coins, spiked to multi-year highs in retail markets. Popular products like American Eagles and Canadian Maple Leafs went on allocation. Dealers reported waiting lists and purchase limits. Delivery delays became common. On the positive side, mining companies finally reaped massive rewards. Shares of producers like Pan American Silver, Fresnillo, Hecla Mining, and First Majestic Silver doubled or tripled in value over the year. Executives appeared on financial media warning that supply can't catch up for years. Attempts to fix the imbalance came up short across the board. Regulators monitored the market closely for signs of manipulation, but found no single actor dominating. This was a systemic issue driven by real physical demand outstripping available supply. Exchanges raised margin requirements to curb excessive speculation. It provided temporary breathing room, but the underlying structural deficit remained untouched. New mining projects. Most major discoveries are years or decades from production. Primary silver mines, those focused mainly on silver rather than byproducts, are increasingly rare in the modern regulatory environment. Byproduct output depends on the economics of copper and zinc mining, which face their own supply challenges and long development timelines. Recycling increased, but not nearly enough to close the gap. Governments discussed strategic stockpiles or incentives for domestic production, but implementation lagged amid competing budget priorities and political debates. This brings us to the most eye-opening part of the story: the modern parallels that make this bank-driven panic buying and COMEX liquidation so unique and potentially explosive. The Hunt brothers' squeeze in 1980 was driven by deliberate accumulation and heavy leverage in a monetary crisis environment. It ended abruptly when the system, regulators and exchanges, pushed back with rule changes. The 2011 peak reached $49 per ounce during a period of quantitative easing and strong investment flows into precious metals. It faded as central bank policies shifted and sentiment cooled. 2025 is fundamentally different. It's consumption-driven rather than speculation-driven. Real metal leaving the system permanently into industrial products that power the future of energy and technology. Industrial offtake at a record proportion, over half of total annual demand for the first time in history. Deficits every year since 2021. Cumulative drawdown from above-ground inventories on a scale that's unprecedented in the modern era. The shocking data keeps piling up, layer by layer. Solar demand alone is projected to hit new all-time records in 2026, even after years of explosive growth and ongoing thrifting efforts to reduce usage per panel. Electric vehicle penetration is accelerating faster than even the most optimistic forecasts from just a year ago. Analysts now see 20 million units sold globally in 2026. Artificial intelligence infrastructure build-out. We're still in the very early stages of what many call a once-in-a-generation transformation. Power consumption for AI training and inference is expected to double or triple in the coming years, translating directly to silver demand that has no viable substitute at scale. Repeating patterns are unmistakable in the market metrics right now. COMEX delivery volumes have spiked to multi-year highs as more contracts stand for physical taking rather than rolling over. Backwardation has appeared in the futures curve, near-term prices trading at a premium to future months, a classic signal of immediate scarcity. Lease rates have hit extremes not seen in decades, richly rewarding those who hold physical silver over paper claims. Investment flows are following price strength, creating self-reinforcing loops that amplify the move higher. But the core driver this time is different from past rallies. It's not fear of inflation or currency collapse. It's not central bank buying or geopolitical tension. It's factories that must have silver to operate and meet growth targets. Demand that's largely inelastic, difficult to reduce without sacrificing performance, efficiency, or market share. This is why short-term pullbacks, when they come, are likely to be shallow and quickly bought. Consumption provides a floor that's higher and more durable than monetary drivers alone. These patterns aren't random coincidences. They're the direct result of silver's unique position in the modern global economy. When industrial demand locks in over 700 million ounces annually, one of the highest levels ever recorded, and total supply, including recycling struggles to consistently hit 1 billion ounces. Any acceleration in growth creates crisis-level tightness almost immediately. Years of chronic underinvestment in new mining capacity, combined with over-reliance on paper markets to set prices, have left the system extremely vulnerable to physical reality catching up. Experts across the spectrum are aligning on higher targets. Citigroup recently lifted their short-term forecast, seeing $70 as achievable soon. HSBC published analysis pointing to $100 as realistic in 2026 if deficits persist. Independent voices like Keith Neumeyer, CEO of First Majestic Silver, have been warning for years that supply constraints could send prices to the moon in a true crunch scenario. Even traditionally conservative institutions admit the old trading range of $20 to $30 per ounce is broken for good. So what does this bank panic buying and COMEX liquidation mean for silver's future? Here are 3 clear takeaways from 2025's dramatic developments. First, institutional shifts signal major changes. When banks that once held shorts start buying or covering, it reflects deep confidence in higher prices driven by fundamentals. Second, industrial demand provides the foundation. Multi-decade trends in renewables, mobility, and computing ensure growing consumption, creating a higher floor even during slowdowns. Third, liquidation phases accelerate moves. When shorts cover amid scarcity, rallies become parabolic. Positioning early captures the bulk of gains. One open-ended thought lingers. If bank accumulation and COMEX liquidation continue, and every indicator from inventory drain to lease rates points that way, how intense could the next phase become? $72 now? $100 as shorts exit? Or levels that truly shock the system and reward the prepared? The reports of bank panic buying and COMEX liquidation in 2025 aren't isolated events. They're symptoms of a market reaching a tipping point where physical reality overtakes paper control. Recognizing these signals early could be the key to navigating the surge ahead. If this analysis has clarified the bank-driven dynamics for you, hit that like button. Subscribe for ongoing precious metals insights as the story unfolds. And comment below, do you believe banks are truly panic buying, and how high does it go? I read every response. Thanks for joining. Navigate wisely, and I'll see you in the next update.